Welcome to Everything Financial Radio. I'm your host, Dennis Tubbergen. I'm here every week at this time. If you are a returning listener, welcome back. If you're a new listener, stay tuned. We've got a terrific show lined up for you this week. Mr. Jeff Kennedy, who's a very interesting guy. He is a commodity analyst with the organization Elliott Wave International, will be stopping by for an interview today. We'll get his predictions based on his analysis where a lot of markets are going to be going. Also, Investors Business Daily quoted an economist this week saying the economy is getting better. Is it? Or does the evidence suggest otherwise? I'll weigh in and give you my take. Also today, we'll be talking about the inflation-deflation cycle. This will be in the last segment of today's program. I'm going to share with you 3 other times in U.S. history when the economy looked a lot like it does today, and I'm going to tell you exactly what happened. Understanding this cycle, I believe, can be very, very instrumental in helping you know what to do with your money. So a terrific show lined up for you today. Couple of quick reminders before we get started. First of all, if you've not yet heard about it, we are conducting a class called New Retirement Rules. The class is being conducted at Western Michigan University's East Beltline campus here in Grand Rapids. We talk about the inflation-deflation cycle. We talk about current debt levels in the economy. We talk about the money cycle. And we talk about the potential predictability as to where we are today and where we're going. There is a cost for the class to cover the cost of handouts and books. It's $49. It's available online. You can register online at newretirementrules.com. You can also go there to get more information about the class. Also, if you've not yet requested our new report for 2013, the report is titled 2013, The Retirement Rules Have Changed. In the report, we'll give you our analysis of the current economy, our analysis of where markets may be headed and how it may affect your retirement. Easy to get the report. All you have to do is enter your name and address, and you can do that by going to mybest2013.com. Those are the words mybest, followed by the numbers 2013, mybest2013.com, and we'll be glad to send you a free copy of that report. Also, if you'd like to go back and listen to any of the interviews we have with our guest experts here on the program, you can do that by going to the iTunes store. Just search under Everything Financial Radio, and all of our previous interviews with guest experts will be there. We're also posting these all at everythingfinancialradio.com as well as YouTube. Just go to YouTube and type in Everything Financial Radio, and you'll find all the interviews there with video as well. I'm pleased to have back on the program an expert today from the Elliott Wave International Group. Joining me today on the Everything Financial Radio Show is Mr. Jeff Kennedy. Jeff is Chief Commodity Analyst at Elliott Wave International. Jeff has more than 20 years of experience as an analyst and trader. He writes and edits Futures Junctures, which is Elliott Wave International's premier commodity forecasting package. And over the last 10 years, Jeff has written a column called Trader's Classroom as well. And, Jeff, we very much appreciate you joining us on the program today.
Dennis, thank you for having me on.
Jeff, let's start with a very basic question for our listeners. What is Elliott Wave, and what can it help someone do when analyzing what to do with their money and markets?
Okay, well, before I answer that question, Dennis, I think we actually need to step back a few steps and let's talk a little bit about financial analysis and different forms of technical analysis. Financial analysis, there's 3 primary types of financial analysis: quantitative analysis, fundamental analysis, and technical analysis. I'm a technician. That's what I do. I do technical analysis. Technical analysis is the study of price. Okay. Now, within the field of technical analysis, there are many different disciplines. For example, candlestick analysis. That was popularized by Steve Neeson. Utilizing indicators and oscillators such as like RSI, MACD, relative strength. Those are different forms of technical analysis. The discipline I follow is called the wave principle, the Elliott Wave principle. And it is a form of technical analysis which is based on pattern recognition and crowd psychology. The whole idea behind the wave principle is that crowd behavior actually has a visual look when illustrated, for example, on a price chart. And so what I do as an Elliottician is I look for these patterns on price charts, and I can put them together, and they form larger and smaller versions of themselves. And from those patterns, that's where we derive our forecasts.
So, Jeff, would it be fair to say that essentially the wave principle is based on the fact that human behavior tends to be fairly predictable, that faced with the same set of facts and circumstances, people tend to act the same way? Is that a fair analysis?
Absolutely, and a great example of just that, so your listeners can kind of get an idea of what I'm referring to, is how many times have you been driving down the highway, and traffic starts to slow down, and then in front of you, you see the car has its left blinker on, and you see a few more cars around you that have their left blinkers on. What do? Well, you put your left blinker on, and you kind of move with the crowd. You don't see what these other individuals are seeing, but still you're following the crowd, and you've got your left blinker on, and you're moving into the far left lanes. That's a great example of crowd behavior and what we do. What's interesting about crowds, and what's kind of scary about crowds, though, is that whenever an individual finds himself in a crowd, they tend to lose their individuality, and they take on the persona and the psychology of the overall crowd, which makes crowds kind of dangerous, actually.
Jeff, there's an old saying in the market, and I think those that are contrarian certainly hold to this view, that the crowd is usually wrong when it comes to, you hear the old story about people jumping in when the market tops, and they jump out at the market bottom. And give me your take on that. Is there some truth to that?
Absolutely. What's unfortunate, and on a more serious note, Dennis, is I don't think it's fair to say crowds are usually wrong at the significant and meaningful market turns. I think it's Main Street that tends to be wrong. Main Street, we sit back, we listen to CNBC, we listen to the talking heads on all the financial news networks, and it's usually Main Street, which is the last one at the party, and unfortunately it's the last one. They get caught holding the bag, so to speak. They pretty much, and anybody who can remember what happened in 2008 to their portfolio, they know exactly what I'm referring to. Unfortunately, a lot of the big players and big banks on Wall Street fared much, much better. So we really can't say that they're part of the crowd. But yeah, primarily at your market turns, your significant market turns, when everybody's the most bullish, that's when you need to be careful and start thinking opposite. Unfortunately, I think people have a skewed outlook on life and financial markets. They have what I call linear vision. And what I mean by that is when the market's going up, they think the market's going to continue to go up, which is why during bull markets you see books come out. Like for example, now you might see a book come out saying, Dow 20,000, Dow 30,000, Dow 40,000. And then whenever the markets are moving down, again, that linear vision is at very much at play. And, it's the whole outlook or the whole attitude is nothing but, death and desperation, and it's going to continue for years and years and years. Well, that's not life. That's not reality. Reality is very much of a roller coaster, or it follows the seasons. To quote a gentleman that I admire very much, a guy named Jim Rohn, actually, where everyone experiences a fall and a summer and a winter and a spring. And you see this play out in financial markets as well, that, whenever the times are good, just, prepare for the times when they're not going to be good, because they will come. And when times are bad, know that they won't last.
Jeff, we have a couple minutes left in this segment. And if you're just joining us, we're chatting with Jeff Kennedy, who's Chief Commodity Analyst at Elliott Wave International. In just a couple minutes, we'll pick it up on the other side of the break. Based on your analysis, give us your assessment of the current economy.
Well, I'm not looking at the economy very favorably right now. In fact, I'm very nervous about 2013, and I recommend a very much of a stance of being of capital preservation as we move into 2013. I don't like what I see. Again, I'm a technician. I look at price charts, and what I see on the price charts makes me a bit nervous, and I think a very cautious attitude and a very cautious posture for 2013 is the way to go.
Jeff, is there a time historically when you look at a price chart that maybe remind you of where we are today? Are there any similarities or is there any point in the past you can point to say we're about where we were back here?
Yes, absolutely. I think the most recently would be, I think, where we're at right now, 2012 is 2013 is very similar to what we experienced in 2007, 2008. The big sell-off we saw in 2008, I'm expecting something somewhat similar in 2013. For those of you who may have longer memories, simply go back to the 70s, and I think I don't know if many of your listeners are familiar with what an analog is. An analog is whenever you take a slice of time, two different periods of time, say like the 1990s, and compare that to the 1960s. And what you do is you can kind of create an analog, and the analog has a lot of weight if there's many, many similarities. And I think what we've experienced primarily in the 2000 period, 2000 to 2010, is very similar to what we experienced kind of in the 70s. So a good analog right now of where we are specifically, say, this year, 2013, I think corresponds quite nicely to what we experienced in, say, 1976 to 1977. So I think the next big move in the overall market will be down. Politically and economically, I think Washington can't do the wrong thing fast enough. And I think economically, there's still a lot of dust that needs to be settled, pretty much.
Well, we will continue our conversation with Mr. Jeff Kennedy, Chief Commodity Analyst at Elliott Wave International, when we return. Stay with us.